The top 5 alternative investments to consider when the stock market is hitting the skids. When the stock market is tanking, many investors assume it's time to run for the hills. The logic goes that if you can't stand the heat, then get out of the kitchen, which is valid advice if you happen to be a cook in a flaming kitchen. Maybe not the best advice if you're investing in stocks, however. That's probably among the worst things you can do when stocks tank and you had long positions in the market. In other words, you're a long-term investor purchasing stocks, hoping that they appreciate. Staying in the stock market is the savvier move. In fact, it's a great time to buy stocks, one of the best. That said though, no portfolio should be composed entirely of stocks. A truly diversified portfolio contains many asset classes, and not just crypto or real estate, or any asset class that you may be obsessed with at the moment. That's the easy answer. And if you're anything like most investors, you probably have a portfolio that consists almost entirely of stocks, with a personal home added on top. After all, they offer fantastic growth potential and can be an excellent way to build wealth over time, particularly if you weather the storm and stick with them. But like I said though, there's more things out there, and a truly diversified investment portfolio has stock, has bonds, has real estate, has other asset classes. Let's take a look at a few of those options that are available to you to help you spread your risk around and grow your wealth. You're watching Finance Squared, and I'm your illustrious host, Derek West. Be sure to like, subscribe, click the notification bell, because we got more great videos just like this coming. And if you want to be in the know when they drop, then that's the thing you want to do. In any case, let's dive right in. Now, an alternative investment is any asset that is not stocks or bonds. Simple, right? That's because it is. Nevertheless, investors often have a hard time deciding which assets to consider alternatives. A rule of thumb is that an alternative investment should be able to offer a decent rate of return while also providing some type of diversification. Most importantly, it should be able to offset the risk associated with an all-stock portfolio. An all-stock portfolio is actually fine. There are many people who have made millions, even billions of dollars investing almost exclusively in stock. However, that can be very risky, particularly in times like these when the stock market is shown to have been a little bit volatile. So when you want to spread your risk around, investing in alternative asset classes, that's the way to do it. Let's talk about art as an alternative investment platform. Art is one of the earliest forms of investment and can be a great way to diversify your portfolio. In addition to that, it can also be an excellent way to add some beauty to your home or office or anywhere where you may be spending a lot of time, which can be a great source of personal enjoyment for you and those that surround you. In general, there are 2 ways to go about investing in art. The first is to purchase existing pieces from art galleries and from other collectors. The second is to buy and resell art from artists. As with anything, both these methods can be risky. And how can you know which artist's art will appreciate in value and which artist's art is just a fad? It's very similar to investing in stocks. How do you know which company is going to appreciate in value and which company is just a flash in the pan? That's where fundamental analysis comes in for stocks. And that's where art appraisal comes in for art. That's a separate topic for a separate video. One of the problems with investing in art for your general investor is that most of the more premium art pieces, you more than likely can't afford to purchase them. Historic and iconic works from legends like Picasso, Rembrandt, or Monet. But there are platforms out there, online platforms, that allow you to invest in art in fractional and other ways. For example, Masterworks, Yield Street, Otis. Those are just 3 examples. There is no shortage of online platforms enabling your average investor to be able to get their hat in the ring and invest more, and invest earlier, and invest better. Certainly the case for art. If you want to get into the art investment game, and you don't have millions to put into buying a legendary painting from a legendary artist, then one of those platforms is probably the best for you. Now that said, that isn't the only way you can invest in art with a low budget. You can invest in art funds. You have most likely heard of ETFs, an index fund for investing in stocks. There are similar funds available for investing in works of art as well. Much like when you invest in an ETF, depending on the amount you invest, you're purchasing fractional pieces of stocks issued by companies. In art funds, you're purchasing fractional portions of many different pieces of art. You don't actually take control of the art in the fund, and that you aren't responsible for maintaining it or finding a buyer when the work has been sufficiently appreciated. So it makes it easy and fun for you, the investor. Now, the number of these types of funds is pretty small, and they're hard to get into, but their popularity is sure to spike as people look for alternative ways to grow their wealth. Let's talk about art indices as a way to invest in art without getting too fancy. An art index is like a stock index fund in that it tracks the sale and performance of various popular art pieces. And just like you can buy into stock indexed mutual funds, or an index fund for short, you too can buy into an art indexed fund. Now, of course, like with anything else, there are some caveats to keep in mind. Just like art funds, these aren't all that popular right now. And because of that, the volume of transactions is quite low. So with low volume of transactions, expect minimal liquidity. And with that, you shouldn't expect to be able to buy in and out of these within days or even weeks. So if you invested in an art index and you really need the cash for some reason, you're not going to be able to pull it out that quickly. So that's a big caveat. It's not uncommon for more popular and well-known pieces of art to be held for decades and even be passed down as family heirlooms. This time between transactions can lead to the prices for these various pieces to be, let's say, inaccurate. And art is a great way to diversify your portfolio because it's less correlated to stocks than other investment assets. That means that even if the stock market is experiencing a downturn, collectors' demand for art will likely stay high, and prices will increase over time. Collectors may also view art as a hedge against a downturn in the stock market, which can encourage demand in a weak economy. It's not all about art from this video either. Let's talk about bonds as an alternative investment option. Many investors view bonds as a safer alternative to stocks. That's because they're debt instruments that are issued by governments or large companies, which means that they have a less risky rate of return. Many experts in the financial world recommend a portfolio that is 75% stocks and 25% bonds. That ratio, according to many experts, is dependent on your investment horizon. In other words, the distance between you and your retirement date. If your retirement date is in the next couple of weeks or months or so, you should be pretty heavily in bonds because they're considered less risky, even if the return is lower. If your retirement date is 2, 3, 4 decades away, you should be mostly in stocks. That's a little caveat out there for those of you that are wondering what makes that ratio the way it is. That ratio is also the way it is because it maximizes the rate of return when the market is booming, and bonds will help to offset the risk when stocks are dropping. That's typically the relationships that stocks and bonds play with each other. In addition to being a great way to offset the risk of a 100% stock portfolio, bonds can also be a good source of income. A lot of government bonds pay a fixed interest rate that is set when the bond is issued. Corporate bonds, on the other hand, can be riskier, but they also have the potential to pay a higher rate of return. You can consider a bond as being on the opposite side of a loan. You see, when a bank issues a loan to you, you owe that bank money. When you purchase a bond, you're actually purchasing a loan that someone else took out. So the person or entity that took out that loan owes the money to you. So if you've ever wondered how to be on the opposite side of the debt cycle, buy bonds. Let's talk about real estate as an alternative investment. Real estate can be an excellent way to diversify your portfolio. It's also a great way to generate passive income, which can help make it easier to retire. One of the best ways to invest in real estate is to buy rental properties and manage them yourself. That way you'll be able to earn a steady income from the rental payments and be able to take out a tax deduction on your expenses. There are many caveats and different schools of thought on owning real estate and rental properties. That's for an entirely separate video. But just know that many people make a lot of money just purchasing houses and renting them out as rental properties. It's a great way to make a little bit of side income and a little side hustle, and a great second income stream. But it's not the only way to invest in real estate as an alternative to stocks. Another option is to buy a REIT that specializes in real estate. One of the upsides is that REITs are a little bit more risky, so therefore they will have a slightly higher rate of return. But that's also one of the downsides because they're a little more risky, and because they're more risky and could possibly have a higher rate of return, they could also go bad more easily. Another downside is that they're less liquid than owning real estate directly. Real estate is a great way to diversify your portfolio because it's less risky, it's because it's less correlated to stocks than other investment assets. Although it is slightly correlated, that means that even if the stock market is experiencing a downturn, there's a possibility that your real estate portfolio could stay high. But at the very least, if you're renting out your real estate to others, you're guaranteed at least an income. And as those properties are paid down, you're also gaining equity. So real estate is an excellent alternative to stocks in any market. Commodities. Commodities, kind of underrated here on the YouTube. Let's talk about commodities as an alternative investment to stocks. Many investors view commodities as the riskiest alternative to stocks. That's because they're used as raw materials in the manufacturing of many goods. When demand for those goods is high, so is demand for the commodities that are used to create them. But when demand for those goods is also low, sometimes those commodities can also go lower. But there are certain commodities out there that have inverse relationships to stocks. Gold, silver, copper, and other precious metals are examples of that. As you can imagine, commodities are also very volatile. Commodities can be a great way to diversify your portfolio because, like I just mentioned, some of them have an inverse relationship to stocks. So when stocks go down, they go up. Sometimes when stocks go up, they go down. And sometimes there's no relationship at all, and it's just correlation and not causation. And like I mentioned, some commodities track with the stock market and are an indicator and a canary in the coal mine, as it were, to let you know where the rest of the market will go in the near future. For example, the run-up in the price of lumber, oil, etc., was an indicator that the general economy was about to experience a pretty bad bout of inflation. So if you were invested in those and you saw the prices run up, you would have had an indication that inflation was going to go nuts. And more than likely, the Fed was going to raise rates to tamp down inflation. Raising of rates was going to affect some stocks, or actually a lot of stocks, in a negative way, lowering your returns in the general stock market. So being invested in those kinds of commodities will help you to see possible inflection points in the stock market that you may want to slow down your stock purchases, at least until the worst of the panic is over. Let's talk about private equity as an alternative investment to stocks. If you're looking for a more exotic type of alternative investment, private equity can be a great choice. It's essentially a type of fund that invests in growing business and then tries to sell them for a profit once they're more established. Unlike venture capital funds, private equity funds generally only accept large institutional investors. That means they're generally only open to the wealthy, but there are ways that you can invest in them if you have less than the typical entry requirements to get started. One way is to look for a private equity fund that accepts smaller investors. They're hard to come by, and they can be highly volatile, meaning there's significant downside risk to you. If you search long and hard enough, you can find one. But the easiest way to get involved into private equity for the small-time investor is to get into an ETF or an exchange-traded fund that holds private equity companies. It's just like any other ETF, as a matter of fact. You can purchase some shares without worrying about minimum investment requirements. There's also the opportunity to invest in special purpose acquisition companies. These companies are shell corporations that make private equity investments in undervalued private companies. If I'm not mistaken, Carl Icahn, Warren Buffett, the companies that those guys operate are SPACs. I'm sure you'll let me know in the comments down below whether or not that's right. Nevertheless, there's also the opportunity to use crowdfunding to get into private equity. Using crowdsourced funding, private companies can raise capital from lots of individual investors instead of a small number of high net worth individuals. Of course, you need to keep in mind that that form of investing is on the riskier side of the investment spectrum, and you're not guaranteed a significant return at all. We're all familiar with crowdfunding platforms like GoFundMe or Kickstarter, but there are others out there that are more investment focused, like Start Engine or Seed Invest. Like commodities, private equity is a highly volatile investment. However, it also has the potential to generate a high return when the economy is strong. When combined with other investments, it can be an excellent way to diversify your portfolio and reduce your risk. The best way to prepare for an economic downturn is to diversify your portfolio. That way, you can be sure that at least a few of your investments will be successful, even if others fail. When the stock market is down, it can be a great time to buy stocks at a discount. But if that's not your bag, you could also consider investing in bonds or commodities as a less risky alternative. But you can also consider investing other alternative investments as a less risky alternative. Whatever you choose to do, make sure that your portfolio is well balanced and includes a few alternative investments at the very least. So let us know in the comments down below what you're using as your alternative investment vehicle, or even if you have an alternative investment vehicle at all. We're all dying to know. And remember, a goal without a plan is a wish, a goal with a plan and no action is a wish list. I'll catch you in the next video. Peace.